Okay, final section on monetary policy and the Fed funds rate. Here's the Fed funds market and the demand for federal funds, supply of federal funds. This is going to be very, very similar to the loanable funds market. We have an equilibrium interest rate. To raise Fed funds rate, the Fed sells government bonds, raises the interest rate, causes the interest rate to rise. Now, there's problems in controlling the money supply. If households hold more of their money as currency, banks have fewer reserves, make fewer loans, and the money supply falls. If banks hold more reserve than required, they make fewer loans, and the money supply falls. Yet, the Fed can compensate for household and bank behavior to retain precise control over the money supply. Now, there could be a run on banks. When people suspect their banks are in trouble, they may run into the bank to withdraw their funds, holding more currency and less deposits. If you want to see a great a great movie clip of this, watch It's a Wonderful Life. There's a bank run scene there. This was an old movie done in the 1940s with Jimmy Stewart. Under fractional reserve banking, banks don't have enough reserves to pay off all depositors, hence banks may have to close. Also, banks may make fewer loans and hold more reserves to satisfy depositors. These events increase R, causing the process of money creation, causing the money supply to fall. During 1929-1933, a wave of bank runs and bank closings caused money supply to fall by 28%. Many economists believe this contributed to the severity of the Great Depression. Since then, Federal Deposit Insurance has helped prevent bank runs in the U.S. But notice there's no Federal Deposit Insurance for anything but commercial banks. Investment banks do not have FDIC insurance. Now, in the United Kingdom, though, Northern Rock Bank experienced a classic bank run in 2007 and had to be taken over by the U.S. government. And the same thing happens in the United States with smaller banks. Oftentimes, FDIC will have to take over those banks because there has been the fear of a bank run. FDIC has been around since the 1930s, and it is very proud of the fact that it has not lost a dime of taxpayer money. Okay, chapter summary. Money includes currency and various types of bank deposits. The Federal Reserve is the central bank of the U.S. The Fed controls money supply through open market operations. Purchasing government bonds increases the money supply. Selling government bonds decreases it. In a fractional reserve banking system, banks create money when they make loans. Bank reserves have a multiplier effect on the money supply. And that is it. That finishes monetary policy.